Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm Paul Peebles, your national underwriter for Old Capital. Joining me today is Dave Walls with Old Capital. Dave is a loan officer for Old Capital down in the Austin and San Antonio market. We're going to talk with him in just a second. We're also going to listen to, in the podcast today, Dustin Miles. Dustin is going to tell an interesting story that he's going to tell to Mike Becker and myself about how he got into the multifamily business. And the last transaction that he had done was an assumption of a multifamily property through Fannie Mae. And I think that's going to be really interesting for people to listen to, how assumptions are done. And so let's get back to Dave. Dave handles Austin and San Antonio for Old Capital. Dave, how are things going down in those two separate marketplaces for apartments?
Well, the market is still very strong down in San Antonio and Austin. There's no doubt about that at all. It's no secret that prices have gone up a little, cap rates have gone down. But if you're prepared to search out the hidden gems, so to speak, there are great opportunities in San Antonio and Austin and the surrounding submarkets.
Tell me a little bit about where prices are. Like in San Antonio, what is a multifamily property per unit cost, and what would a multifamily unit cost in Austin? What's the difference?
Well, just as a kind of a very basic comparison, if you're looking at a mid-70s C-class apartment building in San Antonio, if something that's in reasonable condition, you're going to be paying probably $45,000, maybe $50,000 a door if it's in good shape.
Okay.
But in Austin, that same property in a similar location could cost you $80,000 a door. So
some of these C-class properties are actually trading almost at $100,000 a door.
Yeah, if you're looking at and that's a property that's in pretty good shape right near, say, the universities, right downtown, in a great location, you can pay up to $100,000 a door.
Wow, for a 30-year-old building?
A little older than that.
That is amazing. So the market is still very strong in both locations. And if you can hear from Dave, Dave is from Southwest Texas. What part of Southwest Texas are you from, Dave?
Well, you've got to jump in a boat and row across to New Zealand, Paul.
And how long have you been with Old Capital?
About 12 years.
So he's a wealth of information. How do people that are interested in looking at financing properties down in Austin and San Antonio get a hold of you, Dave? What's your email address and your telephone number?
Well, email address is dwalls@oldcapitallending.com. That's dwalls@oldcapitallending.com. And a good phone number is 972-679-3872.
All right. So, Dave, thanks for visiting with us in the Old Capital Real Estate Investing Podcast. And now let's listen to Dustin Miles. Today in the Old Capital Real Estate Investing Podcast, we have Dustin Miles. Dustin, welcome to the Old Capital Podcast. With me today also is Mike Becker.
Hey, Paul.
So, Dustin, we're going to talk a little bit about your acquisitions of multifamily here in the Dallas-Fort Worth area. And we'll also talk a little bit about your recent transaction called Jane Lane, and you did that as an assumption. So before we get going here, let's have everybody meet Dustin Miles. Dustin, tell us a little bit about you and what your background is.
Sure. Thank you, Paul. I appreciate coming in here and speaking with you guys. So I'm just a normal guy. Grew up in Fort Worth, Texas. Went to high school here. Went to UT for engineering school. Graduated and worked at a few different companies. Worked for a large defense contractor now. So, yeah, it's been a good time, but just regular guy.
So how did you first get interested in doing real estate? What was the reasoning behind you wanting to start investing in real estate?
Sure. So I've always been pretty entrepreneurial. I was a little kid. I had a candy business. In college, I had an internet business with customers all around the world. So coming out of college, I was very entrepreneurial and always interested in real estate, and went to a bunch of different clubs. We started in single family. we ended up buying and selling and renting out 8 different homes, and so kind of got a flavor for that. And we met some people, and they were successful in multifamily, and that's ultimately where we wanted to go.
So what year did you start investing in real estate?
Our first purchase was 2009, November, December timeframe.
Okay. And then how long was your time frame before you met the couple and decided that you wanted to kind of transition into doing some larger properties and doing multifamily?
Sure. We met some friends of ours. We'd known them for a while. Actually, we didn't know they were into real estate and just happened to be talking about real estate, and one thing led to another. He was looking at deals, and so we actually got in our first deal September of 2012.
Okay. And so what made you want to transition from, doing flips and rentals and into apartments? What caused that transition for you?
Well, I like the idea of being able to afford a property management company. I like the economies of scale. It was more of, I have some friends that do very, very well in single family. They do rent. Some people have tons and tons of rentals. Some of them do have multiple flips going on. They do very well. But for us and the amount of time and effort we wanted to put into it, unless you have those systems set in place, it's difficult to get that going. With multifamily, we knew some people and we were being mentored and had those systems in place. And so really all we were doing is we were going down their checklist and being able to step in there, and we're buying a business.
Okay. And so let's just talk a little bit about the first deal that you did. So it was the Lakeside Village Apartments, is that right?
Yes.
And that's in Wiley, Texas, which is a suburb of Dallas. And so just tell me a little bit about that deal. And so you said you bought it in September of 2012. So was the property pretty well occupied, or was it distressed? And just kind of, what have you guys done with it since you've owned it for almost a little over 2 years now, I guess?
Sure. So it was a stabilized property. We were able to get Fannie Mae debt on that particular property. It was 90+% physical occupancy. As far as what we've done to the property, we've done some minor upgrades, some interior upgrades. We added some washer dryer connections. We did some interior upgrades with flooring and light fixtures and things like that. But for the most part, it's been a great asset, cash flowing asset.
Now, you guys did a Fannie Mae loan. Tell me a little bit about how you got into a Fannie Mae loan, because you had no multifamily experience before you bought the property. So were you the managing member, or tell me a little bit about the experience level that you had at the time and the experience level of the managing member who actually bought it?
Sure. So the managing member that bought it had been a passive and a lead or a KP in a previous deal. And so we walked in, we're a KP or in this particular deal. And so we were able to leverage his experience and be able to sign on the loan to further.
So you said KP. What KP stands for key principal, and so that's a Fannie Mae term where Fannie Mae looks to certain individuals within the group to step up and say that they're going to run the property ethically, and so that's what a KP stands for. And so when you did it with the other individual, he was a lead, and you just were a KP on this deal, and you kind of helped him meet some of the requirements from a balance sheet perspective. Is that accurate?
That's correct.
Yeah. So you did it's pretty well occupied, pretty stable going in. You guys just done some little light value add. How's the property kind of generally performed from the day that you guys owned it to kind of where it is today?
Sure. It's been pretty much a turnkey asset. I mean, our cash on cash is, I don't want to give the exact number, but it's way over, double digits, way over 10%. So it's going well. We're looking at options as far as what we're going to do with that property.
Okay, and then the next deal you did, it looks like it was in Denton, Texas. It was called Village East, and you just were a passive investor in that. Is that right?
Yes, that's correct. That was a deal. It came along, and we were actually starting to look at doing our own deal, but that deal came up, and the numbers worked, and so we went ahead and put some money into that passively.
And so you, as a passive investor, you don't really have any role outside of just getting a check monthly or quarterly and just kind of being an investor. So then after that, you just kind of alluded to that you wanted to do your own deal and kind of be a lead in a deal. What made you want to go from the passive role to lead, and what was in your thought process when you made that decision?
Sure. So originally when we were a KP or a guarantor, we signed on that Lakeside Village loan. So that kind of gave us our foot in the door. And so from that point on, we were basically seasoning, as they call it. So we had to wait a year before we could start looking at finding our own property. As far as the reason why we wanted to do that, we wanted to grow. We wanted to, get more and more familiar with the business, learn from as many people as we could, and ultimately, just be able to just grow.
Okay. So you guys found a property called the Oaks of Jane Lane, which is in a suburb of Fort Worth called Haltom City. And when did you guys buy that property?
We closed on it May 30th of this year.
Okay. And so that property, you had a loan assumption with it, meaning that there was an existing Fannie Mae loan in place that you guys just assumed the debt and took the place of the seller.
And why did you have to assume it? Why couldn't you just go out and get brand new Fannie Mae financing on that stabilized asset?
Yeah, so the prepayment penalty on that was fairly large. I don't remember the exact number, but it was a large prepayment penalty.
So Mike, kind of work through with the listeners of what a yield maintenance penalty means for Fannie Mae.
When people are out, when you get a Fannie Mae loan, Fannie Mae takes that loan and they sell it on Wall Street, and they do what's called securitize it. So they sell it to a bondholder, and that bondholder wants to know that they're going to get a certain yield for the 10-year period. And one of the ways to guarantee it is they put in a prepayment penalty called a yield maintenance. But in layman's terms, what yield maintenance means is that if you have a loan, let's call it at 5%, and the current market rates are at 4%, the bondholder would have to go out, if you pay the loan off, and replace a 5% bond at 4%, so they would get paid the difference between the remaining term and that 1 percentage point. And then the reverse is true. If the current rate's at 5 and the note rate's at 4 and the current rate's at 5, then they would go out and replace at a higher rate, so the yield maintenance is a lot lower at that point. So that's the basics of yield maintenance. It's basically just to guarantee that the note holder gets a certain yield over the time period.
Let's kind of work through a typical example. What was the balance of that loan?
Right at $3 million.
So right at $3 million, and what was the interest rate that you guys had to assume?
The blended rate, there were two loans. There was the original and there was the supplemental. The blended rate was about 5.8.
Okay, so there was a first and a second lien against the property. So, and how much time was left on the first lien, and how much time was left on the second lien? They
end at the same point. They both mature midway 2019.
Okay, so we call that coterminous, that both the first and the second lien had to be paid off together. So they kind of follow in suit. So you're not going to have one lien that still has a maturity that goes farther out, that the lender wants to make sure both those loans get paid off at the same time. So again, the loan amount was for $3 million?
Yes.
Okay, the remaining term was a couple of years left in the transaction. And so interest rates at that period of time, which was just back a couple months ago, when you closed that transaction, you could have paid, if you had to pay that loan off, or the seller would have had to pay, a yield maintenance penalty probably closer to $600,000. So that's the reason why Dustin had to assume that mortgage, because the bondholder, just like Mike was saying, wanted to be made whole. And so it would probably take $600,000 on a time value of money, what the remaining term was of the loan, to get that bondholder made whole. So that's the reason why people assume loans these days. And so let's kind of go through that story again, Mike.
Yeah, so you guys bought it in May. You had a little over 5 years left on the loan. You had to assume it. And what you told us, you've done a couple Fannie Mae originations, new loans we did before. What's a little bit of the differences in the process from doing an assumption versus a new loan from your experience?
You always need to work with your finance folks up front, but on an assumption, I think it's even more so important. And so what we did was we worked with Paul beforehand, and I'm not sure exactly behind the scenes what all he did. Sure, there's quite a bit, but he just tried to make sure that everything would work out financially, and that because when you're assuming a loan, the lender's letting someone else off the hook and they're putting us on the hook. And so there had to be a lot of comfort level from the lender perspective. There's a lot of front end work that had to go into that as far as the differences between the two.
So one of the things is that the seller of that one had a pretty high net worth and good liquidity and had owned the property for a number of years prior to Dustin buying the property. So Fannie Mae already had a comfort level with the seller. And so we had to convince Fannie Mae that that new buyer was going to be stronger than the seller. So how many key principles did you have to put on there? Again, these are people that were going to sign on behalf with Dustin as the pool. Dustin shows me how many?
We had 5.
So 5. So that seller we knew was pretty strong. So 5 people were key principals and were going to sign with Dustin on that transaction. So tell us a little bit about, you got 5 people into the transaction to be key principals, and what else did you find out?
How many other partners? You said 5 key KPs, and how many other total partners win the deal?
Okay, sure. Yeah, so we had 5 key principals on this particular deal. A total with the KPs and with our passive investors, we had a total of 29 people, and us included. So it was, we had to raise some money. And another difference between a new loan origination versus an assumption, and this isn't always the case, but with an assumption, a lot of times your LTC's at a lower amount, and loan to cost, sorry. And so we had to raise a bit more money than you typically would.
What was your leverage in this deal approximately? Normally they'll let you do 75%. What was the case here?
We were right at 68%.
68%, okay. And so what drew you to this particular property? Why did you want to buy the Oaks at Jane Lane?
I really like that area of town. It's a nice pocket. You drive up there. It's a nice, clean, safe place to live. It's close to schools. There's some churches around the corner. One thing that I like to do, not initially, but I do drive by at night just to check on the property, and nice and quiet. The only noise that you have is maybe little kids running around doing, playing, but nice, clean property. You also want to look at the comps around them, and I thought Jane Lane was as good or better than those, and I thought we could really do some nice things with the property given what the previous owners had done. They had begun an upgrade program. They did about half a dozen of those, and they were successful. They were able to get much higher rents over their base rent, and so all we're doing is we're going in, we're continuing that program.
And so you've owned it for 4 or 5 months now. So how many of the units have you guys continued and gotten through with the upgrades?
We're a little over 30 of them.
And it's been working out well. Have you guys met or exceeded your pro forma rents?
Yes.
That's great.
We're doing well.
That's great. So, Dustin's been in the business now a couple years, and he was a lead in his first deal and a key principal on another and a passive on another. And recently you bought another property with some partners, and that was Monterey Apartments in Fort Worth.
Yes, that's correct.
And so you were, now that you have a little bit of a track record and experience, you had another person who was going to be the lead in the deal that needed some assistance to come in and get a Fannie Mae loan. And so he asked you to come in and co-lead the deal with them. So tell us a little bit about that process. How did that go? How did you get yourself in a position where other people have sought you out to help them get their deals done?
So this is a person I've actually known for a while. I actually work with this person, and they'd done quite a few single families, and we've known each other for about 5 years or so. They were interested in multifamily. They got into a multifamily mentoring program, and we began talking, and one thing led to another, and we began talking about this Monterey deal and went after it and talked with Paul to make sure we had all of our financial pieces together and made an offer and were able to take it down.
That's great. So now that you're about 400 apartment units, what's kind of the future for Dustin? What do you see the next year or the next couple of years? What are your kind of plans on growth in the industry? Or are you kind of done? What's your thoughts there?
Far from done. Probably going to be putting in more offers in the next week or two. We're always looking at deals. We're looking at deals within DFW, outside DFW, outside the state of Texas. So we're getting after it.
Good. So you're looking to even expand your markets a little bit. So that's great. That's great.
If you were to listen to somebody that is your experience today, what kind of interesting things could you tell them that you found out about the multifamily business? What would encourage them to get into the business?
For them to get into the business, I would say, so I started out in single family. Knowing what I know now, I'd probably skip single family and I'd get into multifamily. But as far as just something, if you're wanting to get into this business, I would try and find some people that are doing just like anything else, whether it's running or doing triathlons or whatever you want to do. Find some people that have already done what you want to do and learn from them and kind of move forward.
Any crazy stories about apartments? What have you found out since now that you're the landlord? Tell us a little bit about anything that comes to your mind that you think would be a good story.
I, fortunately or unfortunately, don't have a lot of crazy stories. I will tell you, we hire third-party management companies, and I do have a story relating to that where I'm thankful I have a third-party management company. We had a main water break at a property. It was fixed within a few hours. And the following day, I was called to say, hey, we had a main water break, and it's already fixed, and it's already taken care of, and everything's fine. And, so no worry on my part, and very happy to have a third-party management company.
That's great.
I mean, that's really the difference about working on your business instead of working in your business, about the one that calls the plumber to try to fix it and then has to get a drill to concrete through to find the pipe. I mean, that's not you. You are the supervisor. You are the general manager. You're the asset manager of the management company. So let them deal with the tenants and the toilets, and you just worry about the bigger picture about what's your next transaction, and just trying to be as efficient as an owner as possible. So the more property you have, kind of the economies of scale, the better you get at this business.
Well, that's great. Well, Dustin, we definitely appreciate your time. If the listeners want to reach out to you, what's the best way to get a hold of you?
Sure, I'll give you my email address. It's Dustin, and that's spelled DUSTIN at milesmultifamily.com. And Miles Multifamily, I'll just spell out the miles. It's MILES multifamily, no dashes or anything.com.
Dustin, thank you for your time. We'll talk to you later.
Thanks.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.